On Wednesday, the Federal Reserve raised interest rates by 3/4 of a percentage point as a measure to stem America's highest rate of inflation in 40 years. The Fed's biggest rate hike since 1994 increases the cost of borrowing money to buy a home, among other things. Now, many buyers are turning back to a familiar tool, the adjustable rate mortgage, which certainly has its benefits, but is not without risk. NBC's Vicky Nguyen has our Sunday focus as part of the NBC News series Priced Out, looking at the state of the American housing market.
Just over a decade ago, the country crippled by financial crisis, fueled by homebuyers with loans they couldn't afford.
What no one can say is how long this housing crisis will last.
One culprit in particular got a bad rap. The adjustable rate mortgage, or ARM, allowed many of those homeowners to overextend. When their rates rose, millions went into foreclosure.
Housing's big slide and the ripple effects just now being felt.
Fast forward,
Home prices have jumped nearly 20% since this time last year.
Today's white-hot housing market, low inventory, and rising interest rates have many buyers turning to that familiar tool, the ARM. Wine distributor Giannina Arturo just closed on this New Jersey house. It's her first home, and she fell in love with the spacious, dog-friendly backyard and room to work from home.
I knew that the 10-year ARM was the way to go. That was the only way it was going to work.
ARMs offer homeowners a lower starting interest rate than a traditional 30-year fixed mortgage, usually lasting 5, 7, or 10 years. The lower interest rate on Giannina's 10-year ARM drops her monthly payment by more than $300.
The difference in that rate between fixed and the ARM was enough to either price me out or price me in.
ARMs can be risky long-term. Just like the name suggests, the interest rate you pay on these loans adjusts after the introductory period, going up or down based on interest rates. With 30-year fixed mortgage rates now topping 6% compared to about 3% a year ago, the number of ARM loans has doubled since the start of the year. But Loan Depot founder Anthony Shea says he's not worried about another mortgage meltdown, in part because today's lenders are more stringent.
You actually have to qualify for a loan today.
Today's ARM is also different. There are limits to how often the interest rate can adjust, and there are caps on how much it can adjust.
Every program could be different, but typically it's 2% per year or 5 or 6% over the life of the loan.
Shea says ARMs work best for home buyers who have enough income to cover monthly payments that could rise 10 or 15% when rates adjust, and for those who don't plan to live in their new home beyond the introductory period.
The same conditions that are pushing your adjustable rate higher at a reset are also going to be pushing fixed rate mortgage rates higher.
Sam Chandon is the director of real estate finance research at NYU. He says fixed loans offer stability.
There is significant value for someone who is going to live in their home long term that allows you to know and understand and plan for exactly what your payments are going to be every month.
As for Giannina, she says she did her homework before choosing an ARM, and the math added up for her short-term and long-term happiness.
I love the house. My dog loves the house. It's exactly what I needed.
And Vicky joins me now live. Vicky, good morning. It's great to see you. As buyers consider these adjustable rate mortgages, what do experts say they should be looking at before jumping in?
Hey, Willie, good morning and happy Father's Day. The number one thing you should do is think through the entire life of that loan. Can you afford it, not just now, but also when it adjusts, because it will adjust. A lot of people, they don't think about that, and that's when they get into trouble, because you may think you're only going to stay in that house 5 to 7 years, but life happens. That is also why it is so important, Willie, to talk to your lender about all the options and terms. Don't be afraid to ask questions, especially if you are a first-time home buyer. Ask all of the questions. You want to know the difference between a 7-year ARM, a 10-year ARM, a 30-year fixed rate. What does that product look like for you over time? Think about your salary as well, Willie. Are you in an industry where you can depend on bonuses to help? Or perhaps you reach a certain experience level or tenure and you understand the tiers of your salary will go up. The opposite may be true as well. Maybe you're in a job that's pretty volatile and you don't have that kind of salary stability. Those are all factors to consider when choosing a loan. And finally, Willie, these loans, they're just like any other consumer product. You can and should shop around and try to negotiate for the very best rate. Willie?
All great advice. It's getting real expensive to buy a house these days. Vicky, great to see you on a Sunday morning. Thanks so much.
Hey, thanks for watching our YouTube channel. Find your favorite recipes, celebrity interviews, uplifting stories, shop our favorite deals, and so much more with the Today app. Download it now.